Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market exploded upward this week as the 2-week correction came to an abrupt end, with the S&P 500 coming down 5.2%, nailing our target as we thought that the SPY would come down to around 245 to 250, and then the market moved up sharply. It bottomed just a few days early based on our analysis, as stocks blasted off right out of the gate on Monday, with the high of the day on Monday 112 points off of the Friday low. The reports that the Omicron variant was much more mild than had originally feared really helped the market. It is 4 times more contagious, as some reports show. However, symptoms have been very mild, and there's the very distinct possibility that it will spread and crowd out the more dangerous Delta variant. That is certainly a hope. Apple led the charge upward on Monday and continued throughout the week. 5 points to the upside on Monday as analysts upgraded that target to 191. And also, airlines and travel surged as people started to look again at the reopening of the economy. Tuesday was the big day of the week. The first 2 hours absolutely exploded, with the S&P up nearly 100 points. That's 200 points off of the Friday bottom. And I can barely remember a time when I can say to you that we had a 100-point up day and 200 points off the lows in just a few days. Techs, solar, energy, everything. Tuesday was a giant up day. Oil moving up 3.7%, and the breadth of the market was up 5.5% to 5.5 times to 1. Advances to decliners. It was just an extremely strong day. But that was really the big action for the week for stocks as they chopped into Friday after that big gain on Monday and Tuesday. And that's despite Pfizer coming out and saying that if you took the booster shot, that's 3 vaccine shots, that it then neutralizes Omicron. And the market continued to jump on Apple stock, but again, not making much more upside ground, even though techs were surging on the upside. Oracle, Broadcom, Cisco, Juniper, they exploded, and even the sickly Facebook, we rate that as a sell, even that got an upside move, but that's in an area that we don't think it's got much more to go on the upside. And the markets were able to completely ignore, with barely a flinch, that out of China, Evergrande officially has now defaulted. And that biggest real estate company with $300 billion in debt should send reverberations throughout the financials all over the world, but barely a flinch. And Friday's CPI up 0.8%. That is up 6.8% year over year. The biggest numbers that we have seen in 40 years. And what did that do? It brought buyers into the stock market. The joke is, and maybe the joke of the week, is that the TV commentators all said, well, inflation is all priced in, and all the coming actions of the Fed is all baked in the cake. That means that the next 2 years of actions, of the next 3 months of winding down that taper, and then the rate increases that are likely to come in 22 and in 23, all of that, all baked in the cake, and nobody cares. So everything is totally bullish all of the time, and of course, we've got something to say about that. Friday, the rally came as this worst inflation that we have seen in decades, and the assumption is that margins in the tech stocks are going to continue to improve. And that's despite supply chain disruptions and shortages out there. And yeah, actually what that has done is push the prices up. Of course, a lot of the output from the tech companies are commodities. Chips are certainly commodities, and that's helped the techs be super performers. Oracle, well, great earnings, up 14% on Friday, and you can see what I mean when you look at stocks like that. But we think that a lot has to do with seasonality and the technical patterns, and we expected the low to come in the first 2 weeks of December. It came immediately in December, and then get a rally. And our work said that we would see the rally go into Q1. We believe that will happen still, and it's likely, however, to be a bumpy road. Even today, when the market moved up and the S&Ps were up 35 points, they did give up most of those gains, and then buyers started to come back into the market again today. With the indexes very much likely to move up, we don't think that all of them are going to make new highs, and we're likely to see a lot of disparity as we get back to those highs that we made just some weeks ago. In fact, we think the S&P 500 and the Nasdaq will barely make a 1 or 2% new high before we get into a much more negative market in the future. I think that there's an important thing for you to be considering, and I'm going to put up one slide in here just for you to get an idea. And I want you to hold on to this image on this graphic because I think it's very important. This came from Real Investment Advice, Lance Roberts, and it was shared by a friend of mine from the CBOE, Kate's dad, and he puts a ton of stuff up, a lot of good stuff on Twitter. So thanks a lot for posting this, and I think this is very important to look at in here as this is very suggestive of the fact that the stock market, well, I've said it enough times, is extraordinarily overdone. This goes back 100 years and looks at historical trend of the S&P 500 and also looks at the major historical events. What it really is important in here is that you can see there as a cyclical action of moving up to very far from above trend and then moving back below trends. You get long periods. This happened out into there was a depression in 1921, 20 and 21. This was at 1929, and then look at how long it stayed below trend. Now, trend is about 80% of GDP. That's not reflected on here, but that's about what the trend is, and this is the exponential increase in the overall trend. And you can see in here, here's that big post-war rally. There's the 74 crash and how long it stayed sub-trend. This is the dot-com crash. It actually took the financial crisis to get it below trend. And this is the everything bubble. So this is the dot-com bubble. This is the everything bubble. It is so far above trend, if you see over here, that what's likely to come are potentially more than a decade of time to get it back below trend. Of course, trend is going to keep moving up, but then the stocks don't have to keep moving up because we're trading at about 200% of GDP, and the exponential trend is about 80% of GDP, so there is a lot of potential correction coming. In fact, the PEs could be cut in half to get down to trend in here sometime in the next decade. So this is a picture that I really want you to hold on to, of course, because here we're coming into year end, and there's a lot of people out there looking for higher prices out into 2022, and we are not. So I thought this was a very good graphic. Thanks to Real Investment Advice and Kate's dad for sharing that graphic. The likelihood in our mind that we'll make a new high, as we said, is pretty high. And we're likely to do it only by a slight bit. But 2022, we think it's a bear market year. And long-term trends, well, they look in trouble. And we believe that for 22, the best investment is cash. Stocks for the week, the major index is up 3% plus. The Dow is the strongest, closer to 4%, and RUD is slightly weaker, the Russell. And that pattern is really bad overall, and I'm going to show you that as we get back towards the end of the show. Bond market 30 years up about 2.5 points. That's, down 2.5 points, and that's after the panic buying that came in the previous week. The 10-year yields have moved up about 12 basis points from the panic low. If you go to our Future Speak show, we had talked about the bottom of the range being 1.34%. It got just about there, and then rebounded up into the 1.51% area and then pulled back a little. Our target for 2022 in the early part of the year is the yields getting up to about 1.9%. So you think the stock market's going to be able to withstand those large increases in interest rates? Well, I don't. That is also going to negatively probably affect gold for the longer term. And if you want to see my big picture analysis on silver, please go to last week's Market Week show, and we had that on there. So gold is about unchanged on the week, just continues to be a dog. And silver worse, down about 40 cents on the week. Dollar unchanged on the week. We think it's going to test 97 again. And watch the euro currency, because we think it's going to be weaker into the end of December. And that, of course, is 57% of the dollar index, the DXY. So if that weakens, you'll see the dollar move up, and that probably will weigh on the metals still. Oil up $1, that bounced into resistance, and our analysis suggests that it's going to move down into February. So please do watch Future Speak. That's our member video on Wednesday, where I show 52 charts in about an hour's time, and we look at the major sectors of the futures markets, including, of course, the stock indexes and Bitcoin and lots of stuff that you want to see. Coming up in this show, we have a preview of stock sectors where you're going to see RV's fantastic analysis on XLK and XLC. And I'm going to bring you some deep analysis on the stock market and share with you our level 4 charts and proprietary indicators. And you're going to think this is fascinating as we look at the S&P 500, the Nasdaq, and the Russell. So that is all coming up. I want you to make sure that you go to askSlim.com and subscribe to the channel. Make sure that you maybe become a free member or look at all of our specials that we're going to offer in there. If you're on YouTube, please do subscribe to this YouTube channel and click that notification bell. Then you'll know when we post videos, and give this video a thumbs up. Tell us that you like it, and of course that helps us. And on Twitter, follow us at askSlim. And for membership info, any questions you have on our huge offerings of education and analysis, please do write to Matt at askSlim.com. Coming up, I'm going to bring you great analysis from RV on the XLK, XLC, and I'm going to take a deep look at the stock market indexes. But first, watch this great special. This is the annual askSlim Holiday Special. Great holiday gifts for traders and investors. Give that gift of askSlim. These are special rates, in fact, the lowest rates ever, and the only time that we do this for 3-month memberships, they're non-recurring. So if you give the gift, well, you're not going to get charged again, or the person you gave it to won't either. Give the gift to someone you know who loves trading or investing, or give the gift to yourself. It's great for first-time members. Or use this special to try our higher levels if you want to try them for 3 months. And a bonus gift for you that includes an Amazon gift card that we're going to send you back, that essentially is going to help you cover some of the costs of this already exceptionally special low rates that we're offering. Take a look here. I'm going to the askSlim website and go right to the top of the page where it says save 30% or more, and click on that, and you're going to see what our specials are right in here. We have 4 different specials, different gift options for level 2, level 3, level 4, and level 4 plus. I'm going to show you some things out of level 4 and level 4 plus coming at the end of the show. And these are the gifts we're going to send you back right here. So you're going to get 30% off, and we're going to send you back $20 for level 2, $50 for level 3, $100 for level 4, and $150 level 5. All that level 4 plus, all that coming in our special gift card from Amazon that we'll be sending you. you're going to find this amount of information to be absolutely astounding. It all starts with level 2, where we have our live chart streams for the SIR grids for short-term traders and the indexes. You'll get our 500 videos that we have, 500 plus in our library. You're going to learn so much. Includes our Future Speak show on Wednesdays. There's so much in there. And then you can get that included with level 3. And everything in level 3 is in level 4. And there is so much. Please go to this page and read all of this. You're going to see everything. And I'm going to show you some of that. So go to askSlim.com and take a look at this special membership right over here. And please do click at that top of the website and on that little green box that you see right up on top, and that is where you're going to go to get these specials. And of course, you can learn so much more about askSlim just by scrolling on this carousel on the top, and we've got lots of videos and things for you to see, and you can explore all of our popular services. We teach you so much. And of course, if you want to be a level 4 plus member, become a Thinkorswim TD Ameritrade account holder, and you can do that by clicking right here. So you're going to get all this information. All you have to do is give that gift of askSlim. All right, so here's a preview of our stock sectors. Avi does a fantastic job with these. He is going to share with you 2 of the many sectors that we look at, and you're going to just learn so much. There's great cycle analysis here and lessons on how to do this type of analysis. With XLK, a super strong tech sector, and XLC in the communication sector being weighed down by a couple of tough stocks. And that one, not such good shape. You're going to find this to be fascinating.
Okay, so this is the XLK, and what we're looking at here in the XLK is a very key 26-week cycle, which is this dotted blue cycle right here. And going back to the 2019 lows back here, you can see they've been super consistent with very key lows that have formed close to the idealized timing going back for many years. So that is really a very powerful thing that you're seeing here in the XLK. You can see that the XLK has just been forming a series of positive cycles in each of these cycles with higher cycle highs and higher cycle lows throughout this whole time period. So no reason to really be bearish on the intermediate term in the XLK, as it really hasn't given any clear shifts in terms of that weekly cycle configuration. What's going on now is that we are still fairly early in this rising phase. And you can see we have very positive upside momentum here as well, which really has been positive since this week right here, the week of 10/18. This turned up and has been positive since that point. Overall, we're still looking for higher prices here. We're looking for a move to the top of this blue zone from 174 to around 182. So looking for another 10 points or so of likely upside here in the XLK. Our next key low, which we show using these blue vertical timelines, is due 221 to 411. So that's the overall forecasted timing here for the XLK. And lastly, I do want to note that Apple plus Microsoft make up just about 45% of this ETF. So this is a very concentrated ETF, and I just always note that you always want to know what you own. And currently, if you're long the XLK, you own mostly Apple and Microsoft. So this is the XLC, and a few things I want to note here at the onset is that if we add the weighting of Facebook plus Google, that equals right around half of this ETF, or 48% of this ETF. So this is a very concentrated ETF. What we're looking at here is that this is a likely breakdown. We were looking for a bottom to form 927 to 11.8. We got a very muted rally. I mean, really barely readable, honestly. And then we have already turned back down on the downside. Our key weekly low is at 78.74. So looking at this little bit of a rally in the context of negative momentum to really fail, and looking for this to roll back down on the downside if we are in this corrective period right here. Our next key low is due 221 244. Now, what would change this overall picture? Well, if we were to break out through that intermediate 78.6, which comes in around $80.62, and then break out through that weekly cycle high here at 82.35, that would really indicate that a late low formed. So I just wanted to share that with you because you always want to know what would change your overall analysis. And in our case, if we were to break out through that 78.6 and then break out through that cycle high, that would very clearly indicate a late low. But given everything we're looking at, some of the evidence does favor overall lower prices, looking for a move down to this intermediate 127.2 at 72.71, and then the intermediate 161.8, which comes in at around 70.13 or so. So that's the overall picture here in the XLC, overall bearish and looking for lower prices.
Great work on that, Arvi. And those of you that are interested in learning cycle analysis, you can get information on that on our amazing 21 video module workshop by going to our workshop tab at askSlim.com, and there's a lot of information and a video on there, and you'll learn a lot about this great way to look at the securities or futures. It works really on everything that we do. All right. We're going to look at the stock market now, and we're going to do this differently than we normally do. I'm bringing you our proprietary charts. These are the chart grids that we share with our level 4 and level 4 members with our proprietary indicators. Since we're in our period here of the askSlim Give the Gift period, where you can give the gift to anybody, including yourself, I want to show you really what's included in level 4 as we look at this deep analysis in the stock market, S&P 500, Nasdaq, and the Russell. I'm going to the multiple chart grid that we have in here, and I'm going to show you 4 different charts on each of these 3 indexes, and you'll learn a lot by looking at this. I know this, for those of you that are first looking, and I'm zoomed out pretty far here, a couple of years, this is a busy chart. There's a lot on here and a lot of notes, which our members really get to be familiar with. What we're looking at the bottom here are cycle brackets. These are the guides to help us see the rhythms in the market. There's actually 2 on here. The grayed out one right there is one that's a little smaller and was a little older, and the dotted one is one that's a little longer and a cycle that was just recently recognized on the 21st of November. So what we look at, we're always revising and looking at these cycles so that we can better understand them. And cycles are essentially the rhythms in the market. Money flows. And when cycles are formed very bullishly, where they rally most of the time and have small corrections, that's called the right-hand translation. And when you get that, it's a very high probability the next cycle will also be a positive cycle, at least surpassing the previous high. The yellow oval areas are where the little corrective periods are, and when the top comes earlier, well, then those are much bigger corrective periods. When the top is late, as you see in each of these cycles, the corrections are small. We had looked for a pullback in the stock market of about 4.5 to 6%. The decline in here in the S&P 500, right in here in that 2-week period, was 5.2%. Our target was right down over here, about 4,500. It got down to about 4,495, and we said it would be at the most probably 250 points, and that is very close to what it was. So we call this one a bullseye. Well, maybe slightly off the mark because we thought that the low would come a little bit later. It actually bottomed about 3 days earlier than the earliest time frame that we thought it would do that. However, this big up week that you see right over here, it's kind of buried in our lines, is big enough to confirm that we are now in the next minor rising phase that you see right over there, which aligns very closely with the shorter grayed out one here. All of this a rising phase. That's why what we believed that the low would be made in December, somewhere in between these 2 time range lines, and you could see it was just on the outside of that, and that it would go to a new high. That's the highest probability. The projections that we have are either stalling at that minus 61.8 and then turning back down, or being more aggressive on the long side and getting up over here to about 48.70. That's the bottom of that fib extension. There's a dominant 78.6 at around 48.90 or so. So 48.70 to 48.90 is the outside. That's why we said in the beginning of the show that we thought it would be maybe only about 1 or 2% above the old high before the longer term cycle patterns that you see right over here, before those come into play. I'm going to go far out here for you to see how those line up, and you can see it coming down right in here. When they were both coming down right in this area right there, that gave you a very significant decline out into this corrective period back in way back here in 2018. So we're getting into a period right in here that is a lot of risk. That aligns with our monthly patterns and our quarterly patterns, which all suggest that the stock market will have a rough period into the middle of next year. And we talked in the beginning of the show that we thought it would be a significant top, and we're getting into this very risky period. So you can see we're projecting down to that 20% decline, which is a bear market, but it could go further than that. And there could be more than just this decline time-wise, which goes into the middle of next year. It could be a longer period of time based on the fact that it has a lot of correcting to do based on how far it is from the average growth rate and how far it is above the GDP rate. So all of that makes it massively overpriced and sets up a pretty good size correction. We're going to do a big picture video where I'll show those long-term charts just in the next couple of weeks. So that's a look at the weekly chart, and I'm going to go a little bit faster now because I've explained all of that. Here's your daily chart, and what this daily chart is, it has in there our complex cycle structures, and you can learn more about that by becoming an askSlim member. And you can see in here that the normal structure has two different, the lower two different channels in there. When it blasts off into the a third channel up on the top, that is really shows you that there's a tremendous amount of strength. The magnitude of this advance was very strong. Still, it wasn't strong enough yet to turn our option bias indicator. You could see right over here it's yellow. It went neutral from green. You see all of this positive period right in here, and then it turned yellow right here. So it's still neutral. This needs to confirm and turn positive. If it doesn't do that, it says that longer term trends are starting to weigh on it. So we're going to be looking for this to turn green, and that's a P3 level, we call that, and right now it is at neutral still. That's an important indicator, option bias indicator at neutral. This is the momentum conditions right now, and this is the slim ribbon right in here, and shown in a different form than we normally show it on this show. Because it's in these, it gives you these shaded areas in here, and it has turned positive again. So it went negative for a brief period of time. The slim ribbon PO turned neutral right over here, and now the slim ribbon is green and positive, and that gives you an indication that it is likely that for the short term there is upward momentum that will continue to help the market move to the long side, to the upside. Here you have our 2-hour charts, which are really phenomenal, and on the bottom of that is the two indicators, the slim ribbon PO, which you could see when it turned negative in here, it was giving you these negative resumption momentum condition signals. And then the slim ribbon, this is our market condition indicator. And again, this is proprietary. You need to be a level 4 member to get these indicators. And when it comes down and tests under the 25, doesn't get below the minus 25 right here, and then turns back up, that is positive. What that says is that the longer term conditions are still driving it to the upside, and that is a very positive condition. Look right over here, the slim ribbon turned positive, the slim ribbon PO turned green, and you get this upward resumption for momentum signal right over there on that green arrow. All of this is positive. So that was a look at the S&P 500. Now we'll look at the Nasdaq, and you'll see a very similar occurrence in here, though the Nasdaq didn't quite get the size of the launch on the upside, but pretty close. Hit those support areas just perfectly. The timing wise was just a little bit early right over here. This is that longer S&P cycle that we're looking at, and you can see that we have both projections in here. This is coming up and testing the old high just above those fib confluences, and this is the bottom of that fib extension. That's about 17,200. That's about 1,000 points up from right here. This old high right over there and those fib confluences, that's just at around 16, or between the area of 16.6 and 16.8. That could be where it stops in here, or it could take the upper track. The upper track is the highest probability right now, as it is in the S&P 500. So we're going to look for those levels, 17,200, unless it tells us something different along the way. Let's look at the short-term pattern right in here in these complex structures, and you can see that this is actually not as positive. This was a more negative cycle right in here on the minor cycle. It gets right into these resistance zone between the 61.8 and the 78.6 and this fib extension area, and is struggling a bit. And this is despite Apple. Apple, of course, a heavyweight in here, and Apple up at an all-time high as I speak right now, but this is not been able to give you quite the upside magnitude or get through the resistance areas. So we would rate this a little bit weaker based on the pattern than we see in the S&P 500. So it's going to have to give us a positively configured pattern in here and not break down sharply off of these levels in order to give us something really positive. This level down over here, which is the supports from the weekly low, and below that 55,500 would be a very bad occurrence if it got below those supports and down there, and that would be a breakdown and would give us a reason for concern. Here we have the momentum conditions, very much like what we showed in the S&P 500, as the momentum now has turned positive in here, and it's likely to be driving it on the upside. We look at that. Let's go back here, and you can see again on this daily chart that the OBI, the option bias indicator, is neutral in here. Look while it was green in here, and you can see the upward force that it was giving the market. It was just super powerful. Then it turned neutral, which isn't that bad. You can see in here where it was negative down over here, and when you see these lighter green dots, it's even more slightly oversold. So there was a lot of downside pressure here, and then it went neutral and then turned positive, and now it's neutral again. So it has some work to do in order to give us some sense that it is positive. And again, this pattern not as strong as the S&P 500. Here's your upward momentum, which has improved on the short term on the Nasdaq, and here is your 2-hour chart. Now this looks a lot like the S&P 500, which had these sell warnings, and here it was a little choppier as you got into this downward movement. Right here it turned neutral. Here's where it turned positive, and this turns green, and now you get this upward resumption for momentum signal there. The askSlim market condition indicator comes down and tests the swing zone, which is what we want to see it do, and then move up again, which is positive. And this is all fairly positive when you look at that. So a lot of good things when we look here at the S&P 500 and the Nasdaq. Either they're positive or they're improving to positive is what we see. And here is the Russell, which is a very different picture. You can see in here the magnitude of the advance. Well, this is a reflection of interest rates. I said early in the show that it is fairly likely that interest rates are going to go up and that it's not baked in the cake. And you can see that right here. Momentum, a downturn right in here on the intermediate, where momentum on the S&P 500 and the Nasdaq were both positive. So this is a much weaker condition here in the Russell. And what we're looking, this was a 12.7% decline. It was a much bigger decline. And to us, that makes this a sell zone right in here. If it's able to get up above 2267 up to here about 2340, to us, that would be the best. And that's why we think that if the stock market overall makes a new high on the broad market, the Russell is very likely to underperform and then be the leader on the downside over here, where we believe that the market is going to be moving down into the May-July period there with some very hard selling we would expect there. So that's the weekly Russell. It's in much worse shape than the S&P 500 or the Nasdaq. Here's the complex patterns right in here. Whoops. And you can see that what we're looking at is a failure here in these minor resistances and a sell, while the S&P 500 got up into a third channel way up here. This is failing in the second channel, and that shows you the power in these resistance zones right in there. We had it marked the sell zone, and if it gets underneath this level at 2150, that is going to be a very bad sign. I would watch that for the stock market, because if this happens and it gets under there, all of that is going to tell you that the stock market may not be able to do as well as just testing the old high before the market does begin to move down. Now, right in here, this is really interesting because see these orange dots? This is the option bias indicator. And when you get orange dots, it tells you there is an extreme situation and a reversal pending. Here you could see it called the top right over there, and where the orange dots came right over here, that is on our option bias study, that made the bottom right there. So that shows you extreme overbought, extreme oversold, and really called those turns on the stock market. But the Russell, as you see, is quite weak right now. Right now, the option bias indicator is at neutral. Here is the momentum conditions, and look how horrible this is compared to the other indexes we showed you. Here you could see it was green and positive, and all these signals giving you upward movement. It then turned neutral, turned negative here, and it is still negative. And look at this negative signal right now on the slim ribbon PO. That is showing you a lot of weakness right over here in the Russell, contrasting what we see in the other indexes. Here is just the beauty of looking at these patterns in here. Here's where you had a negative downward turn right there. This was on November 15th. The slim ribbon PO turns red as the slim ribbon goes into a negative configuration. You get downward resumptions right in here, as you can see, and it turned neutral. It gave you a little positive reading, but now it's turned neutral and red again. This is really an indication of the weakness that we see in here. Look at this market condition indicator. It was positive way up here in the 90s. It rolled down, gave you a test of the 25, breaks below the minus 25. It's a negative cross and continues to be in very negative condition. So this shows you the amazing contrast between these indicators. So that is a look at the 2-hour chart in the Russell, and at the Russell, very negative. Here's your S&P weekly, your S&P daily. Let's go back to that weekly a second. Momentum conditions in here, still positive on the weekly. Here's your daily, here's your momentum strong, and this is your Nasdaq, the beginning of a rising phase, and momentum in there is strong, moving up. That's the reversal scout. Here's your formation in here, a little weaker than the S&P 500. Momentum strong, and an upward positive turn there on the market condition indicator. And here is the much weaker Russell, as we expect it to move up and fail again. And conditions in here much weaker as it moves down from the sell zone. Conditions here on the daily short-term momentum bad and negative signals, and in here a very weak condition on the 2-hour charts. All of those charts available to you. All you have to do is become a level 4 member at askSlim, and you can do that by clicking on this green button at askSlim.com, and that will take you to our special gift memberships. And here, if you take membership number 3, which is our level 4 membership, you're going to get our charts live on Thinkorswim. You'll be able to do that, and we're going to send you back a $100 gift card to help you pay for that. Level 4 plus get to have custom chart work from us and interact with us much more, and we're going to send you back a $150 gift card. If you sign up for those, you get all of this fantastic information. If you don't want to sign up as a level 4 member, sign up as level 3, and you will still get our information. This is the askSlim rankings. This is a fantastic information that you see in here, and that gives you all of our rankings on long-term, intermediate, short-term, our option bias indicator, and you get our charts right over here. But they're in static form, they're not live, and we update those all the time. And you can see in here, well, here's gold. As you can see, it's been negative, the GDX, and there's the future right over there, very negative. But here I want you to see the S&P 500, the Nasdaq, and the Russell, and you can see that the 3 to 6 week outlook favors, in this case, we're waiting for the OBI to turn positive to go to very bullish, but it is bullish. The Nasdaq is bullish, and the Russell is slightly bearish, neutral to slightly bearish. All of these are the important indicators you can get. And of course, you can still see our charts, and I'm just going to click on the S&P 500 for you to see, and it'll blow that chart up for you. So you can see our chart work on the weekly. You can see our chart work on the daily just by becoming a level 3 member. Use that special gift membership right there for level 3 or level 4, and you'll be able to see these charts. That is it for the week. Please go to askSlim.com and become a free member at least, so you can keep in touch with us, see what we're doing. Subscribe to our channel here on YouTube and give us a thumbs up. Make sure you click that little bell so you know when we post videos. And watch in the playlist. There's a lot of member videos in there, and you'll be able to see a bunch of our past videos. Follow us on Twitter at askSlim. And for any information on all this stuff I just showed you, please do go to askSlim.com or write to Matt at askSlim.com, and he's going to help you with everything I put up there. Amazing stuff. I hope you found this show to be incredibly illuminating. That deep look that we took at the indexes, hopefully you get an idea of the quality of work that we bring to you. Please do be incredibly careful. It is so crazy out there. And I'm always wishing you great trading.
Well,